The growth portfolio is an intermediate term trend following strategy. It is 100% systematic in nature. It's our most popular product with active investors, and it's also how I manage my own personal super fund for my family, and how I also manage money for the public. So what you can see in front of you at the moment is the downloadable spreadsheet, which is available about an hour after the market closes each evening. And as you can see, everything is really color-coded. So we divide the portfolio up into, or the signals up into different risk categories, exactly what is discussed in Unholy Grails. And basically we suggest that if you're a conservative investor, you trade the top 50 stocks. If you're not quite that conservative, maybe trade the mid-cap 50, which is the next 50. And if you're a little bit more growth orientated, which is where I trade, then you trade the small ordinaries, which is the 100 through to the 300. And if you're a little bit more aggressive, you can trade anything beyond the ASX 300, so long as the liquidity requirements are available. Now you can see here that you simply put in your account balance. We just use a default account balance of $100,000, but let's assume you've got a $25,000 account. So you put in your account balance, and we strongly recommended that you stick to the 20 positions, again exactly as what is discussed in Unholy Grails, and it will calculate for you automatically how many shares to buy the next day. So you can see here that we've got new entries pending for today, and the signal that was generated in Unity Mining, that's an orange one, so that's an aggressive stock. If you're not in an aggressive stance, then you would ignore that signal completely and simply wait until your color-coded signal comes up. So this position is pending. It is to be bought, market on open on the next day. You can see the last traded price is 14.5, and based on a $25,000 account, you would buy 8,621 shares. The next column down is exits pending. You can see at the moment there are no exits pending. If we scroll a little bit lower, you can see some of the current open positions at the moment. So we've got a grey position here in James Hardie. The entry price is a dividend adjusted $5.99 back on the 28th of October 2011. So we've almost held that position for a year, and the open P&L on that is 45.5%. Westpac, News Corp, IIN. IIN is a blue stock. I personally have it in my own portfolio. It was bought at a dividend adjusted $2.77 back on the 2nd of December 2011, currently showing a profit of 36.5%. And you can see here that the different color coding is pretty obvious, and you should be able to tell which stocks are suitable for yourself. As the market gets a little bit of steam, you can see the red ones slowly accelerate. Now remember, over the last 12 months or so, it really has been a flight to quality stocks. So you can see at the top here there's a lot more green stocks, but as the market picks up, you can see we start going a lot more blue and a lot more red as the aggressive stocks come along. Now, as we scroll down a little bit further, you can actually see my own trades over the last 3 or 4 years. So this is part of the transparency that we provide our clients. We also show exactly which positions I hold at any given time, but subscribers can go back and have a look at exactly the trades I've made for myself over the years. So you can see since January the 1st, 2009, I've made 145 trades, currently got 20 positions open. Remember, I trade this exactly the way as instructed, so that's 20 positions, and we've had 125 positions closed during that period of time. Now, winning percentage a little bit low at the moment, 43.5%, and that's because the market has been range bound. But had we had this conversation back in early 2007, that winning percentage would have been up at around 60%. So look, it swings around abouts. The pendulum moves one way, back the other way. At the moment, it's obviously not particularly strong, but we still have a very, very good expectancy. So the expectancy here is 7.59%. Now that is a non-compounded expectancy, and what that means is that every single trade I place, regardless of whether it's a winner or a loser, the average trade place makes 7.5% profit. Now let's assume we have a $100,000 account. For argument's sake, we're going to have 20 positions, so each position will be $5,000. So assuming $5,000 allocated to every position, we're making 7.5% on each one of those trades, or a profit of $380. We multiply that $380 by the number of trades, in this case 145 trades, and we have a net profit during the period of $55,027. So based on a $100,000 account, we show a 55% return. That's non-compounded back to January the 1st, 2009. So that's almost 3 times the amount of what the actual market has returned. The general market has returned 20% for that period. We've returned 55%. So that's a reasonably good result considering the sideways movement in the market over the last few years. So hopefully if we can get a bit of bullish momentum going, then we can see that pick up and outperform the market. If we continue to scroll down, you can go back and have a look at all the trades placed since the 1st of January 2009. So you can see back here, Macquarie Communications, that's back on 17th of March 2009 when the system turned back on again. So that's the front page of the growth portfolio. Let's move and have a look at some of the performance summaries. So as part of the transparency, we showed my own portfolio and the positions it's held since the period. However, we do also look at 180 random portfolios for the same period of time. That gives us a good expectation if you started at a completely different day, what your portfolio return would possibly be during that period. So here you can see we've got 180 portfolios. Now, of those 180, all 180 or 100% are profitable. So that's the first thing to understand. The average return of those 180 portfolios is just a little under 45%. Now, of the 180, 99.5% of those, or 179 of them, are actually outperforming the All Ordinaries Accumulation Index. So not only are you profitable, but you're also outperforming the market, which is the whole goal here. So the average gain versus the index is 19.6%, and the one that is behind the index at the moment is only down 0.09%. So it's not a great deal, but the whole idea here is that it doesn't matter when you start, it's more important to start and follow the strategy, and over the longer term the strategy will actually benefit you by providing a profit and also, more importantly, beating the market. Now, if we put that into graphical context, you can see here that the first portfolio was started in March, or in fact started on the 10th of February 09, and its return 75.35% for that period versus the index return of 51.47, so an outperformance of about 30%, there of 23.8%. and so on and so forth. So let's say that you started on the 27th of March 2009. Well, you would have returned 77% versus the market of 41% and an outperformance of 35%. So you can see here on the graphic that the grey is the growth portfolios, the whole 180 random, going left to right across the screen, and the blue is what the market return is for the period of time. So the whole idea here is that we can see different returns depending on start date dependency. Obviously, had we started an optimum period of time, which would have been around the 16th of March 2009, had we known that in hindsight, you would have returned so far 101% versus the market return of 55%. However, had we started a little later down in here, you can see that we're more or less aligned with the market return. So it just depends on exactly when you start. I don't have the exact right date that you have to start, but what we do know is it's more important to start and stay with the strategy over the longer term. So just to reiterate, this is the growth portfolio. It's how I personally manage our own family's super fund and also manage money for clients, but you can operate it on a self-directed basis through any broker that you like. It's important for you to know that I trade alongside you, doing the exact same signals, and then I report all my returns and results and positions for full transparency. So if you're looking for an investment strategy, one that will beat the market over the longer term, one that you don't want to use a financial planner or managed fund, then I strongly recommend a look at the growth portfolio. And of course, we're always here to answer your questions for you.